Okay, so let's talk about Winnebago, ticker WGO. They just dropped a first quarter report that was, frankly, a blowout. On paper, this is the kind of thing that should have sent the stock to the moon. But something kind of weird happened. The market's reaction was, let's just say, complicated. So we're going to dive into this pop and fade and figure out what it all means for the road ahead. Right at the top, CEO Michael Happe basically gave us the theme for the entire quarter with this quote. This isn't a story about a hot economy lifting all boats. No, this is a story about a company putting its head down and focusing on sharp, disciplined execution. You got to keep that in mind because it's really the lens you need to see all these numbers through. All right, let's get right into those headline numbers. And just to be clear, this wasn't some tiny beat. This was a massive upside surprise, pretty much across the board. So get this. The street was looking for adjusted earnings per share of maybe 13 cents. Winnebago comes in and delivers 38 cents. I mean, that's not just a beat, that's nearly a 3 times beat. A huge number that definitely got everybody's attention right away. And you might think, okay, they probably just cut a bunch of costs to get there. But nope. The top line, the revenue, was also incredibly strong. It came in at over $702 million, which just smashed the consensus estimate of about $630 million. That awesome revenue number translates to 12% year-over-year growth. You have to remember, in this kind of environment where investors are picking apart every consumer company, posting double-digit growth like that, well, that's a really powerful statement. What's really interesting when you look at the whole table is just how solid the beat was. It wasn't one single metric carrying the team. We're seeing it in GAAP EPS, non-GAAP EPS, and revenue. But for me, the crucial number is that net income. $5.5 million in the black. That is a huge swing from the loss they posted in the same quarter last year. That feels like a real inflection point for profitability. So the big question is, how did they pull this off? Well, it all goes back to what the CEO said. They focused on what they could control. And you can see exactly how that strategy is playing out right here. The growth was really driven by their core RV segments. I mean, towables were up over 15%, and motorhomes were up more than 13%. And get this, even their marine business, which has been a tough spot for the entire industry, managed to grow over 2%. So this isn't a story about one hot product. It's about broad-based strength. And this perfectly illustrates what management calls their barbell strategy. It's actually pretty brilliant. On one end of the barbell, they're pushing affordability and value with models like the Grand Design Transcend and the Winnebago Thrive. So they're capturing those buyers who are really watching their wallets. But on the other end, they're driving innovation and gobbling up market share in the premium motorized space with their Newmar and Grand Design lines. They're playing both ends of the market, and it is clearly working. Okay, a strong quarter is one thing, but for investors, it's all about what's next. So let's talk about the road ahead, and specifically, the guidance. And they delivered here, too. They raised their full-year revenue guidance to a new, higher range of $2.8 to $3.0 billion, and they also bumped up their adjusted EPS forecast. Look, a beat and raise is the gold standard for an earnings report. It's management basically telling the world, hey, this momentum is sustainable. So this is where the story gets really fascinating. You've got a massive beat, a guidance raise, and a clear strategy that's firing on all cylinders. The stock should have just soared, right? Well, that's not exactly what happened. Let's look at the market's mixed verdict. In the pre-market, right after those numbers came out, the reaction was swift and exactly what you'd expect. The stock was indicating a huge gap up. It was trading higher by as much as 18%. The initial verdict was a massive thumbs up. And sure enough, as soon as the opening bell rang, the stock opened at $47.66, reflecting all of that early excitement. But then, by the end of the day, the stock had faded all the way down to $43.73. That's a drop of almost $4 a share from its opening price. The initial pop just didn't stick. So to be fair, the stock still closed up over 8%, which is a solid day, but it gave back more than half of its initial move. This pop and fade really makes you wonder, were investors just taking some quick profits, or is there a deeper skepticism here about whether the RV recovery is really sustainable? So that brings us to our analysis here at the next call. We're going to filter out the noise of one strange day of trading and focus on the fundamental picture. This is the key question, isn't it? Was this strong quarter a one-off fluke? Or is this the start of a real, durable turnaround for Winnebago? Here's how we see it. First, you have to trust management's guidance. They're telling us to expect a seasonally softer second quarter, which is normal, but, and this is the important part, it will still be stronger than it was a year ago. So the things to watch are continued market share gains and their progress on paying down debt. If they keep executing this well and the macro environment doesn't throw a wrench in things, we see a clear path for the stock to retest those highs. At the end of the day, the fundamental story here, the big beat, the raised guidance, and the disciplined execution of a really smart strategy is just more important than that intraday fade. The company is controlling what it can, and it's working. For that reason, our rating on Winnebago is outperform. And as always, this is not financial advice.